Hello everyone, how are you? My name is Bharat Anuragi and today I am going to cover a very important topic from a financial market, that is bonds. To understand the bond, first of all, I am focusing on financial market because it is a part of financial market. So financial market is a marketplace where you are creating and exchanging of financial assets. What is the meaning of financial assets? Means the shares, debentures. Most of the people are buying the securities from the market, who are investing into the companies, different companies. So it is a marketplace where you can invest or you can borrow the money from a market. It's like other market where you're buying and selling of commodities, like you're buying a vegetable, buying a fruits from the market. So there is buyer and seller is there. Same like in a financial market, some people have access of the money, some people have a deficit of the money. They are both are meeting there, and financial market is establishing a link between the borrower and saver of the money. Means the deficit unit and the access unit or a saver unit, they can meet with each other and exchange their money for some exchange of some securities. So we have two types of two financial market in our country, popular financial market in our country. The first is National Stock Exchange, second is Bombay Stock Exchange. And when you talk about financial market, you can classify it into two parts. First is capital market and second one is a money market. Capital market basically deal with a long period of time, longer period of time. If you want to buy a security or issue a security for more than 1 year, so you have to prefer your capital market. And capital market is also classified into two parts, primary and secondary. So primary market is for new issue market. When you are issuing your security for the first time, then you have to go into the primary market. And when you already purchased or issued a security, and the people who already purchased, they want to sell that security to some other person, then you have to go in the secondary market. Same like when you purchase a new car, you are buying from the dealership, you are purchasing it from the primary market. Once you use it, then you want to resell it to other person, then you have to use the secondary market. And in both the market, you have to use two terms, debt and equity. So debt means you are taking a loan type of thing, like you are taking a credit and you have to pay it back. And in equity, you are giving your ownership to the person. So we will understand these few terms and then we get about the bonds and debt also, debentures also. Okay. And second one is a second type of market in the financial market is a money market. Money market deals with a short period of time. Basically, I'm talking about less than 1 year. If you are borrowing a money or issuing your security for less than 1 year, then money market will help you. So okay, so to understand these basic two terms, that is very important for us. First is equity, second is debt. To understand this concept, let's discuss a story with you. You heard about it that last few days, Modi meet with the top Indian gamers. I don't know, it is a market stunt or whatever it is. But what one thing I know, YouTubers who are playing games or online and streaming games, they're getting a popularity. So I decided that I will also do this because everything is in this line. I will enjoy by playing the game. Yes, I will earn. Also, there is a chance that I can appreciate it by the PM also. Yes. So finally, I decided to set up a YouTube streaming channel of gaming. Yes, I will play the games online. To set up this, after set up this, you should think about, I get money, I get fame, I get name, I get subscribers, everything I will get. So it's a must plan. It's a very good plan for me. So to execute this plan, I need to set up. I need some studio type of thing. So I need 10 lakh of rupees money investment in it. And I only have 5 lakh rupees in my pocket. What I can do for rest of 5 lakh rupees? What is the option for me? So I have two options. Either I can issue my equity to other person and they will buy the equity and they will become the owner of my business. Whatever I am getting, whatever the money I will earn from this studio, I will share with that person. And second option is to take a debt. I can take a loan from the other person and I can invest in it and I will pay fixed interest on that money that I borrowed from the person. So I have basically two options, equity and debt. So let us understand in detail how equity works. Okay. So when first time a company is issuing its securities into the market, it is considered as IPO, initial public offering. So equity, I'm talking about IPO. So suppose that I need to collect money from the financial market and I divided the whole amount into the shares. Into a share means one share, one paper. One paper price is only 100 rupees. Okay. If you're buying one paper, you only need to give me 100 rupees and you become the owner of one share. Okay, so totally I have divided 10,000 shares of 100 each. So 10,000 shares into 100, you will get, means I will get total 10 lakh rupees. So if you are buying, suppose that 70% of the shares of the company, if you're buying 7,000 of shares of the company of my business, then you will become a 70% of the owner of my business. If I will purchase 5,000 shares, I will become the 50% share of the 50% owner of the business. So in this way, equity works. So basically, I'm dividing the ownership into the small parts and issuing into the public, and public is purchasing and they becoming a owner of the business. Okay, what is involved in the equity? We will understand it. So equity shares are the source of finance of a firm. Yes, we know there are some features of equity share. The actual owner of the company, and they are the actual owner. Yes, when you are buying equity share, you are becoming an owner of the company and you are bearing the highest risk. How risk? Yes, in equity share, if you are buying equity of the company, you are bearing the risk of the company. Why? Because you are becoming an owner, and who is bearing the risk in the business? Owner. But how it works? Suppose that you purchase the shares of rupees 10 lakhs, 100% you purchase it, and in the when I operate the YouTube channel, after operating 1 year, I not received any money, and in totally I have to pay some electricity expenses, Wi-Fi expenses, and maybe some other expenses. So I have spent around 10,000, 1 lakh rupees more. So that 1 lakh loss is beared by the you, because my capital will decrease in the end. I started with a 10 lakh. Now I have maybe I have taken the loan for 1 lakh rupees to operate my expenses, or I have spent my cash that is available in my bank, in business bank account. So that 1 lakh is decreased. So that is loss for the owner of the business. So highest risk is bear by the equity shareholder. And yes, you can transfer your equity share to other person in the secondary market. So suppose that you are in today to you purchase the equity shares of Reliance India Limited, and after 10 days you realize that the Tata will earn more. So you want to sell your Reliance share to some other person. So in secondary market, you can easily transfer your share from one person to another. But what you will get in the end? In the end, you will get the profit. What the profit that distributed between the shareholders is called dividend. So in the end, you will get a dividend, because company is not declaring 100% of the profit as a dividend. Company will retain some part of profit in a business for the further use or the future use, and the part that distributed between the equity shareholders, that is considered as dividend. Okay. The liability of equity share is limited to the extent of their investment. So if you are investing, suppose that you are investing 7 lakh rupees in my business out of 10 lakh, and if I taken a further loan from the bank of 20 lakhs, and I face the loss of, suppose that 20 lakh, everything is burned due to the fire. So you only need to pay the money that you invested in the business. If you invested only 10 lakh, you have to pay 10 lakh. If you invested 5 lakh, you have to pay 5 lakh. If even I am occurring a loss of more than crore, you only need to pay 5 lakh. Means your liability to bear the loss in the business is fixed, is limited, is not more than the investment you made in the business. I cannot ask you in any case for the more money if you have paid the investment amount in the business. Okay. And one thing, you also get the right to control the business affairs. Means you are eligible to interfere in the business decisions by doing some votings. You have voting right. You can vote in the major decisions of the company. So you have some little control on the business. So there are also some types of shares. We have equity shares, we have preference shares. So today we are dealing in the bonds. So we will discuss this topic in another class. So now second thing is debt. First thing, I can take a money from the owners of the business, or I can taking the money from the outsider as a owner. So I don't need to return the money to that person. I only need to pay the profit to the person if I am getting a profit. If I'm in the loss, I don't need to pay any profit to that person. But in case of debt, think about how debt is working first. So debt is also kind of a bond. What is difference between bond and debenture, we discuss later. So first is bond. Suppose that I created a paper and I've written that it is a bond of 100 rupees. If you are purchasing this, you have to pay 100 rupees to me, and in return of it, I will pay around 10% or 20% interest every year at a fixed rate, and it is compulsory for me to pay. Even I'm occurring a loss, I'm having a loss, I'm facing a profit, I have to pay that interest. So I divided my all requirement into a paper of 100 rupees, and I am going to pay 8% interest. Suppose that I'm paying 8% interest for 10 years, and I have divided all the 10 lakh rupees into 10,000 bonds. So basically, I'm issuing 10,000 bonds of 100 each at 8% per annum for 10 years. This is the condition of bond I'm issuing. So after, when you purchase all the bonds of 100 rupees of 10,000 bonds you are purchasing, you will get 10 lakh rupees. I will get 10 lakh rupees as a debt. But in debt, I have to pay fixed rate of interest. I am in the loss or in the profit. And what for you don't have any voting right in the business. You're not able to take the decisions. You are not able to participate in the management of the business. You are just treated as the creditors of the business. There are few instruments that use in the debt, like bonds, debentures, loan, ECB, T-bills, commercial paper, certificate of deposit, and many more are there. So that are the things that we are discussing today. Okay. So what is the difference between bond and debenture? We discussed that bond is a type of security that we are issuing into the market, and we are taking the money on a credit. You are a creditor of a business. So in Britain, when these type of borrowings takes place by the business owners, they called it as a bond. They are issuing the paper to the person and taking the money from them. So they are considering that as a bond. And same thing happened in the America, and they are considering as a debenture. So only that due to the name of the country it changed. Basically, we are dealing with we are taking the money as a credit from the outsiders. And in some books it is also written that bonds, when government or public sector undertaking are borrowing the money from the public, then they are issuing the bonds, when private players are taking the money from the public, then it is considered as a debenture. So I think take it. These are the few examples of few difference between bond and debenture. Basically, it is the same thing, only the naming change. What is the features? Borrowed fund. Once you given the money to me, it is a borrowed fund for me, and I will treat you as a creditors. I will give you a priority. In case of loss, I have to return your money. Yes, fixed rate of interest you will get either in the condition of profit or in the loss. Compulsory payment of the interest. It is compulsory for me to pay the interest to you on a fixed period of time. After the completion of the year, I need to pay the interest to you on a fixed rate that I already declare before issuing that debentures. At the time of issuing the debenture, I mentioned that I will pay 8% interest. So that interest is compulsory for me to pay. And security, yes. Most of the time when debentures are issued to the market, it is issued on some basis of security. Suppose that I have a building and I'm using that building as a security while issuing the debentures. Suppose when I'm issuing a debenture, I'm saying that this is a building and the price of this building is suppose that 10 lakh rupees, and I'm issuing the debenture of 10 lakhs to you. In case I fail to pay the money, I fail to return the money to the debenture holders, then you have the right to sell the building into the market and take your money. So basically, you have a security that your money is not going anywhere. Your money is safe. And these are redeemable also. Means in equity shares, when you are giving a money to a company is never returning your money. If you want to get your money back, you have to sell your share to another person. But in case of debentures, there is a category of debenture that is redeemable debenture. Company is redeeming your debenture, means company will pay your money back after 5 years or 10 years, whatever the condition was there, and a company will purchase security back, means debenture back with them, and they will pay your money. But you don't have any voting right. You are not allowed to participate in the decision making of the businesses. So these are the categories of debentures or bonds we have. So I'm talking about the examples of debentures and bond, but these are different categories. Here it is written as debentures. You can also consider as bonds. Same thing. Okay. So on the basis of security, there is secured debentures. And when I'm saying debentures, it is bond included. Okay. So secured debenture and unsecured debenture. When I'm issuing a debenture against any security, means I'm declaring that I'm issuing this debenture on against this building. So this is the building that used as a security to pay the money to a debenture holder in case companies fail to pay the money. Okay, so this is secured debenture when the debenture is issued against any asset. When debenture is issued without any asset as a security, then it is unsecured debenture. Same like on the basis of tenure. If tenure is fixed, that I will redeem your debenture after 10 years, so that is redeemable debenture. If tenure is not fixed, if it is not declared that company is going to redeem your debenture, so maybe company is going to use your money lifetime. Definitely the company will pay interest on it, but the money is not returned to the debenture holder. And there is one more category of debentures is convertibility. Convertible debenture and non-convertible debenture. The debenture that converted into the shares after a maturity period, so that are convertible debentures. That are not converted into the equity shares, that are non-convertible debentures. Same like coupon rate debentures. Some debentures have specific coupon rate and some has zero coupon rate. We will discuss about this in the next slides. Okay, so I'm leaving it right now. And on the basis of registration, there are some registered debenture on which your name is written. So suppose that I am issuing a debenture to Mr. Rohit, so Rohit's name is there. Even I am holding this debenture, it belongs to Rohit. But in a bearer debenture, it is like a note. The person who is holding the debenture is considered for that person. Like suppose that you have 100 rupees note, so it is a bearer note. If you are owing, you are having that note, I will consider that this is your note. If I am having a note of that 100 rupees, this is considered that this note belongs to me. Same like a debenture. If it is a bearer debenture, whoever is holding that debenture is considered the owner. If it is a registered debenture, in that case, anyone can hold that, but the debenture always belongs to the person whose name is written on that debenture. Okay, so now I am covering the important one, that is coupon rate debentures, specific coupon rate and zero coupon rate. Okay, before covering that, first take a difference between T-bills and government securities. Okay, what is T-bills? And most of the time you heard in the news that there are treasury bills and government securities. So most of the times people consider government securities and bonds the same thing. It's actually the same thing, but how it is different from T-bills, that we are discussing. So basically T-bills and government securities. So government securities is used as a debt instrument in capital market. Means when a government is issuing its securities to raise the money in a form of loan from the market, then government can issue government securities. Okay, it is for a longer period of time. We will see the difference also. And when government need to arrange money from the market for a shorter period of time, then treasury bills is used. So treasury bill is for shorter period of time and government securities for a longer period of time. Okay, so T-bills can be used up to 365 days, basically up to 1 year. That duration is like 14 days, 91 days, 182 days, 64 days, like that. And T-bills are always issued at discounted price. So if it is but government is not going to pay any interest on it. So how how the people will earn on it? Suppose that government issues a T-bill of 100 rupees to you, and government said you hold it for 14 days. After 14 days, I will redeem it. So you said, okay, if you redeem it, how much you will pay? So government said, I will give 100 rupees. So you said, how I get earn here? How I will earn here? So government said, you don't need to give all the 100 rupees. Just give 70 rupees to me. I am giving you a security of 100 rupees to you. When you redeem it, you will get 100 rupees. And the 30 difference is the profit for you. It's basically the interest. So you are not getting direct interest on it, but the gap is here. The discounted price is here, is the profit for an investor. The minimum price of treasury bill is 25,000. If government is issuing treasury bill, the minimum is of 25,000. Okay. And in government security, it is from 1 year to 20 to 30 years government is issuing. Most of the time, all marketing company, fertilizer companies, government is issuing these securities to like these companies and borrowing monies from them. In this securities, you are getting principal amount plus interest on it. Suppose that one security is of 100 rupees and the interest is fixed is 10%. So every year you will get 100 rupees interest on it. But sometimes government can also issue these securities as a form of bond at discounted price. Suppose that suppose that government is issuing 1,000 rupees debenture, not debenture, 1,000 rupees bond, but issuing price, the issue price is 900 rupees. and government is saying when you redeem it, I will give you 1000 full money. So that 100 rupees is your discounted rate. So when a government security is issued against a discounted prices, then it is considered as zero coupon bond, means zero interest bond. Government is issuing securities, government is borrowing money from the public for a longer period of time and not paying any interest on it, issuing at discount and redeeming at par. So the gap between it is the interest, or is the earning for a investor. Okay, and this discounted bonds is known as zero coupon bond. These are the coupon bonds. Example, if zero coupon bond is there, so coupon bond is also there. Suppose that this is a bond of $50 and 6% interest is fixed on it, and these are the coupons attached on it. In the end of the year, you can redeem and you can take this coupon to the government and take your interest of it. Once you finish all these coupons, in the end of the 20 years, or it means there's 20, 1 2 3 4 5 6 7 8 9, one more is maybe there is 10. So after 20 years, your all coupons are redeemed, only this security is left, so government will return your $50. So this is coupon bond, where coupon is attached of 50 of some rupees, or so of some money. So that is coupon bond. And when it is issued at a discounted price without any coupon, without any interest, that is zero coupon bond. Okay, so commercial paper, there are other securities you are used in the money market, is a commercial paper, same like a treasury bill. When government is issuing treasury bill for shorter period of time, arranging the money from the public, borrowing the money from the public for 14 to 365 days, it is a treasury bill. Same thing is if done by the private or public sector companies, and they are arranging the money for meeting their short term needs, and again the maturity period is up to 1 year, up to 12 months, then this is considered as commercial paper. When government is issuing treasury bill, when private company is issuing commercial paper. And same thing, if it is issued by financial companies or banks, then it is considered as certificate of deposit. These are the same things but by the parties: government, treasury bill; private, commercial papers; and for banks, certificate of deposit. So now think that. So coming back again to the topic, I need 10 lakh rupees to set up this. So I decided that I will take 5 lakh as equity and 5 lakh as a debt. And in equity also, I invested my 4 lakh. And 1 lakh I issued in the public as a IPO, initial public offering, and 5 lakh I taken as a debt from the market. So basically I am issuing my debentures into the public because I am a private player, so I am issuing a debenture. Same thing is done by the government. If same thing is done by the government, so government will issue the bonds to arrange the debt from the market. So in the Shark Tank, there was a news that ARR Court has raised 30 lakh, 10% on equity, for 30 lakh for 10% equity, and 20 lakh as a debt. So you can arrange both the money from the market. Now, moving towards the next topic here. So I hope you all know or understand about the financial instruments, debt instrument, financial debt instrument. These all are the instruments that I discuss here are used to collect the money and in a form of debt or in the form of debenture or bonds. Okay, and where I discussed that the types of debentures, these are the types of bonds also. The bonds are also same here. Now moving further, yes, credit rating. One thing is very important included with the bonds is the credit rating. When a company is issuing its debentures or bonds into the market, or a government is issuing, so credit rating is very important. What is credit rating? It is basically like you heard about that just recently a movie launched, Maidan, and IMDb rated as 8.9 on out of 10. So rating, they are giving a rating that so you get an idea how good it is. Same like credit rating is given to the different countries government on the basis of their performance of securities. Let me discuss how it works. So there are basically two types of securities: gilt and junk securities. See, these are the map of the different all the countries of the world, and these are the types of rating like AAA, A plus plus, AA plus, AA, AA minus, A plus, A minus, triple B plus, triple B minus, double B plus, double B. So like this type of rating is there. So more the green means more the good positive rating, more the reddish negative outlook it is there. So these are the country with the good rating, and these are the country with the bad rating. So these countries where those who have green rating is considered a grid edged company, means they are performing good in the securities, in the bonds also. And the countries where quoted red or marked red, these are considered junk edged company. So in India also SEBI notified that if you are issuing a security in India for more than 18 months, you must credit rate yourself, means you have to identify in which category you are falling, then you can issue the security into the country. So in guild, if you are issuing a security in guild edge countries, if guild edge countries are issuing a securities, it's definitely you will get a return, because it is a safe, more the green, more the safe that. So you get assured return, unlikely to default on payment. There is less chances that your payment will get default, like US. If you are if US government is issuing its securities, so more likely you will get the interest and you will get your money back after some years. It is not going to be default. So if you are getting a if you are getting a fixed interest, you are getting a assured interest, you don't have risk, so means the return is also low, so government will also pay you low returns. On the other hand, so like treasury bonds like 2% interest. On the other hand, if a company may default, there is a chance that company may default, the company can offer you higher return, that's why you will attract towards it. So 15 to 17% return will there. So where India is falling here, so India's rating is like triple B here. So one more decrease in this number, we will categorize into the junk, means high risk, highest risk, or default type of thing. So these are the ratings done by the Moody's, Standards and Poor's, and some Fitch. These are some rating agencies that are rating the securities and the countries also. So what are the factors that affect in the credit rating? That fiscal deficit of the how much country's government is borrowing, how much expenditure of the government, how much earning of the government. So that is considered. How much infrastructure is improving in the country, inflation, GDP, foreign investment, everything is considered before rating a country's credit rating. If everything is improved in the country, so obviously the credit rating will improve in the country. If these things are decreased in the country, so your credit rating will also decrease. So if suppose that if India's credit rating decrease, then most of the countries who are lending money to us, they will think twice before lending to us, because there is more likely that there is a chance of default. And if our credit rating is improved, so everyone is ready to pay the money to us, because they get assured interest also, they get their money back after some years. And also we get the less interest money. We don't need to pay higher interest to the other countries who are lending to us. If we are categorized under the junk category, then we to attract the investors, to attract the funders, we have to give offer them more interest. So now what is bond yield? It is also related with it. Suppose that the 100 rupees bond is there at 8%, I issued for 5 years. So every year you will get 8 rupees earning. After 1 year you will get 8 rupees earning. So your bond yield is 8 rupees. Basically your bond yield is 8%. The whatever yield means here, earning, whatever the benefit you are getting from it, that is yield, and your yield is 8% here. But now I need money. After 1 year I sold it to some other person, to second person, and I need the money in very emergency, so I sold it at a less price. Now I sell the same bond for 90 rupees. I face 10 rupees loss on the bond and sell it to the second person for 90 rupees. And now second buyer will get current yield again 8%, and 8% of 90 is around 8.89% yield. Now think, that buyer purchased the bond of 90 rupees. Actually the price is 100, but he purchased from me, so I offer him 10 rupees discount. So he purchased for 90 rupees, and earning he get 8%. So in the last end of the year he get the yield of 8.89%. Again this buyer sell this security to another buyer for 80 rupees. Now third buyer purchases it the same security for 80 rupees, and he will also get the 8% of interest. His yield is increased to 10% now. So now what is the pattern here? When the bond price is decreasing in the market due to some reasons, when the bond price is decreasing, the yield in that bond is increasing. And if you are holding your bond for 5 years, in the end, whatever the earning you are getting, that is yield to maturity. In the last, whatever the earning you are getting, that is bond, that is yield to maturity. So when the prices of bond is decreasing, whenever the price of bond is decreasing, the yield on the bond will increase. That is the question may be asked in the MCQs in the exams. What happened if the bond prices are decrease, or what happened if the bond prices are increase on the yield? So that will ask in the question. So Gilt Edge government, what happened here? Suppose that a government is assured that like a US government, that is very assured that they will return the money, so they will issue the security at 2% yield, 2% of the per annum on the money that they are borrowing. But suppose that a government that is not stable, not so if the government is not stable, and people who purchase the securities of that government, they will make panic sales because they are getting some news in that something is going wrong with the government, so they do the panic sale by the investor. So in that way, when they make panic sale, they decrease the prices of bond, and bond yield will go high due to that. So suppose that first buyer purchased 100 rupees one bond at 2% interest or 2% yield. So he is getting 2% interest, but he sold at 50% discount to second one. So second one is purchased just for 50 rupees, and he is also getting 2 rupees. The yield price is getting doubled. So now when the yield price is getting double, the credit rating will goes down. Why? Because yield is, you are paying more yield to the investor, you are paying more yield to the persons. So now next time you have to offer higher interest to attract the persons. So you will categorize under the junk bond here. So basically I have tried to cover the few topics related to the bonds and securities. I hope I covered most of the things related to the bonds and you like this session. If you have any comment, any doubt, you can ask me. Thank you for this session. We will see you in the next class. Thank you so much.